Alright, so you watched my last video about the top 7 reasons why thousands of Canadians are leaving Canada to pursue life in another country. And it got you thinking about how you could go about exploring this idea for yourself and your family. But before packing your bags and handing in your 2 weeks notice, it's a good thing you're now watching this video because there are actually a lot of things that you need to consider when making a move like this one, specifically relating to taxation and residency rules, which I know can be really dry topics to cover, but they're basically the foundation of immigration and moving out of Canada, other than selecting the country that you'll be heading to, as well as understanding their immigration policies. So based on the engagement and comments that I received on my last video, there seems to be a ton of interest from all of you about how you can actually go about leaving Canada. So as a result, I've decided I'll be making a 3 to 5 part series in a playlist here on YouTube. Make sure that you subscribe to be notified of each chapter in this series, covering why people are leaving, things to consider before leaving, how you can work in other countries, where you could consider heading, and a variety of other topics. So with that said, let's get into today's video covering things to consider before leaving Canada. Oh, and by the way, the information I'm sharing in this video is actually a full glossary and guide of information that I've been compiling from hours of research and paid consultations with cross-border tax accountants and strategists over the past year or so. So considering this is information I actually worked relatively hard to compile and make sense of for myself initially, well, I'd really appreciate it if you could leave this video a like and consider subscribing. Alright, so the first thing you need to ask yourself is whether or not you're actually looking to 100% sever ties with Canada, or if you want to split your time between Canada and another country, say the US, Mexico, or any other country. And this is a really important first consideration because it will heavily dictate things such as whether or not you remain a Canadian resident, where you'll pay taxes, if you're still eligible for Canadian healthcare, if you're allowed to vote in Canada, and a couple of other things that we'll be discussing shortly. That being said, I want you to first understand that if you're a Canadian citizen, you will never 100% fully sever ties with Canada because Canada is a country that allows for dual citizenship. Okay, so a Canadian will not lose their citizenship if they ever leave the country for work over a couple of years, let's say, or even take on another nationality altogether. If you have Canadian citizenship, you can leave the country for as long as you want and then come back to live here if you so choose down the line. Okay, citizenship is different than a residency. That is something that's very important to understand. So it's not ever your citizenship that's in jeopardy here, it's going to be your residency status that will change if you leave Canada. And it's this residency status that impacts ongoing obligations, mainly being tax obligations, truth be told, to the country. So let's unpack this a little bit more because things get a bit complicated in regards to whether or not you're a factual resident, a non-resident, a deemed non-resident, or a full-on immigrant. I know this sounds overly complicated, and that's because it kind of is. Okay, so you are a factual resident of Canada for income tax purposes if you keep significant residential ties in Canada while living or traveling outside of the country, which is most likely what you are right now if you live and work in Canada for more than 6 months of the year or full-time for most of you. Now, the term factual resident means that although you might be in and out of Canada periodically throughout the year for vacation purposes or other purposes like work potentially, you are still considered to be a resident of Canada for income tax purposes. And I'd like to explain what residential ties means as it comes up quite a bit in determining your residency status. So residential ties are divided into 2 categories, being significant residential ties, such as a home in Canada, a spouse or common law partner in Canada, and or dependents that are still in Canada. And the second category are secondary residential ties, which can include personal property in Canada, such as a car, a Canadian driver's license, health insurance with a Canadian province, or even economic ties such as a Canadian bank account or credit cards. These are considered to be secondary residential ties. All right, and so this is the main reason why Canadian snowbirds, for example, people are able to leave the country for a maximum of 183 days per year under the 183-day rule, where because they often maintain significant residential ties with Canada, such as their home, bank accounts, and so forth, a vehicle potentially, they remain factual residents of Canada for tax purposes. The only thing is that they are not able to work in the US unless they have a US work visa, which is another topic altogether that we'll cover later in the video. This brings us to the second type of residency status, being a full-on non-resident, which usually happens after someone chooses to fully emigrate from the country, severing residential ties with Canada altogether, which it needs to be noted that this does come with further taxation called the exit tax that we'll also cover later in the video. And so a non-resident, though, is someone who does not meet the criteria of residency in Canada under its tax laws based on the person's residential ties to Canada. So we're talking about not owning and maintaining a primary residence in Canada, or not having a spouse, common law partner, or any dependents that still live in Canada either. Additionally, non-residents typically spend less than 183 days in Canada per calendar year, as spending more than 183 days in Canada as a non-resident could actually trigger what's known as deemed residency for tax purposes, even if the individual doesn't have any residential ties with Canada any longer. The bottom line for non-residents, though, is that generally you don't have to pay Canadian tax anymore, except on sources of income that are accrued inside of Canada. So even if you've left the country and aren't a resident anymore, if you're earning income from, say, investments, real estate, or any other form of Canadian source income, you will have to still file a Canadian tax return and pay Canadian tax on that income, which definitely sucks and makes things a little bit more complicated. For example, if you're living in the United States, you will have to pay your US income tax, but then you're also going to be subject to paying income tax in Canada on that Canadian source income, and the United States taxes income worldwide. So it becomes relatively complicated, and you need to make sure you have a proper tax strategist in place, as well as accountant, to make sure you're being double taxed as little as possible. Let's now briefly cover this idea that we just touched upon, being deemed resident, which truthfully is going to be relatively rare, but I still think it's important for you to know about, so that this video can serve as an all-encompassing guide to tax residency for Canadians looking to potentially leave the country. So a deemed resident is someone who does not have significant residential ties to Canada any longer, and who isn't considered a resident of another country under a tax treaty between Canada and that country, but who has stayed in Canada for 183 days or more in the tax year, right? So unlike a snowbird, for example, who is usually doing that full 183 days outside of Canada, but still retains a home and other residential ties in the country, so they're a tax resident of Canada still, well, a deemed resident is someone who is in Canada for more than 183 days of the tax year, but doesn't own any property or have bank accounts and so forth. So the reason why you should just be aware of this is because if you do end up, say, selling everything and leaving Canada, but choose to come back here and stay with, say, family for 7 months, well, you could be considered a deemed resident, which means you're a tax resident of Canada for that year. Now, the next category you could fall into if you're someone who's retaining residential ties with Canada, but choosing to split your time with another country is called a deemed non-resident, which happens if you've established residential ties in a country that Canada has a tax treaty with, like with, say, the United States, and you are considered a resident of that country, but you are otherwise a factual resident of Canada, meaning you maintain significant residential ties with Canada, right? And so I know this sounds really complicated, but essentially you could be considered a deemed non-resident if you choose to leave Canada for more than 183 days of the year, therefore becoming a tax resident of, say, the United States. However, you maintain residential ties with Canada through, say, holding on to your home. So you'll be a tax resident of the United States, for example, but since you're maintaining those residential ties ties with Canada, they may consider you a deemed non-resident, where the same taxation rules and policies apply as non-residents. So this essentially means that, let's say you want to leave Canada to live and work in another country utilizing a work visa for a country that Canada does have a tax treaty with, let's say the United States, because that's the simplest example, where you're now a tax resident of the United States and you live there 9 months of the year, but you're keeping your house and other ties like bank accounts, a car, and so forth, well, chances are you'll be considered a deemed non-resident of Canada, so you'll only be paying income tax on Canadian source income for those years in particular. I really hope this section didn't bore you to death. I know it's pretty dry information that's a bit complicated to grasp, but it took me a while to also synthesize all of this info for myself, and I really wish a video like this had existed when I was looking for the information. So if it's helping you out, please consider leaving a like, and let's now get to part 2 of the video. Alright, so now that you better understand the implications that your residency status has in regards to ongoing income taxation, well, you need to consider a handful of other important elements, such as obtaining a work visa for the country that you're interested in, because you can't simply pack up your bags and head to that country, at least not once Trump comes into office. Jokes aside though, this is one of the most, if not the most important and potentially difficult aspect to leaving Canada, because in most countries, in order to legally be present in the country, especially for work purposes, you need legal documentation in the form of a work visa. And this is something that can be quickly overlooked when thinking about leaving Canada, as most people are more preoccupied with the implications on the Canadian side of things. But it's just as important to prep for the other countries' work policies and tax rules. Now, realistically, this could be its very own separate video, as the topic of work visas is quite complex and very diverse. So I will be making a video more specifically for US work visas in the near future. Make sure you subscribe to the channel so that you don't miss out on that one. But the gist of it for US work visas, at least, is that you need to get sponsored by your employer or obtain a visa through an investment in the country. That can take many forms. So if you're a working Canadian that works for a company that has ties and business in the US, by far the easiest path is to get the company that you're already working for to sponsor your work visa if they say have a division in the US that you could be a part of. In fact, I know quite a few people who have been able to move to the US utilizing this method. It's usually one of the simplest if you have access to it, and if you stay long enough, can usually lead to a green card. Otherwise, the second most common way to enter the US for work is through an E2 investor visa, which is designed for individuals from countries with which the United States has a treaty of commerce with, such as Canada, and essentially this allows foreign nationals to enter and work in the United States based on a substantial investment in a business they will own or operate. Now, the eligibility requirements for this type of visa aren't fully set in stone, in that the substantial investment required isn't totally defined. It's going to be case by case. And I've spoken with a couple immigration lawyers about this, and even they had differing opinions, but it generally hovers around at least $100,000. So if this is an avenue you're willing to explore though, severing ties with Canada and investing in a business in the US, I'd highly recommend you consult with an immigration lawyer. In fact, regardless of the type of visa or even the country that you choose to move to, it should be a non-negotiable, in my opinion, that you consult with a tax professional to at least wrap things up cleanly here in Canada for a more smooth transition. That being said, other countries outside of the US don't have the same level of scrutiny and difficulty to obtain a work visa. For example, if you're between the ages of 18 and 30, or even 35 in some cases, and you want to move to countries like the UK, Australia, or New Zealand, there are work visas in place. For the UK, you can apply for a 2-year visa by providing only £2,500 in savings, so a month's worth of rent in London, and the application fee is literally £300. Other countries that are actually relatively easy to get a work visa from, if you're between between those ages of 18 to 35 are Australia, New Zealand, Ireland, Germany, Japan, France, and even South Korea. The only real problem here is that these visas aren't end-all solutions to leaving Canada, because they all require you leave the country and return to Canada after you're done with the visa, which is generally going to be 1 to 3 years. That being said, if you do obtain one of these visas and then decide that you want to stay longer term in that country, it might sound a bit out there, but generally the easier way towards full residency permission to a country is to marry one of its citizens. This is the case for the US, Australia, and most other countries as well that you're probably considering. So I know that obviously that's probably not going to be one of the top options for you, but it's still needed to be mentioned. To summarize, you need to obtain a work visa for the country that you're looking to move to, and you can find a lot of information online for most of these countries. Moving on, often the most stressful part of leaving Canada has to do with tax implications on departure, yes, but also the potential ongoing tax implications if you own certain assets and business interests. So we need to cover the famous departure tax, also known as the exit tax, along with other considerations if you're someone who has a lot of assets, especially at the personal level, right? Meaning not sheltered in a corporation. And I'll preface this with saying that generally it is so much easier from a taxation standpoint to leave the country permanently and become a full-on non-resident when you're younger. And I say younger here, but really what I mean is if you don't have any assets, any dependents, or any businesses that will remain in Canada for which you have an ownership stake in. So let's first cover the departure tax, where essentially individuals are considered to have disposed of their assets, with some exceptions, mind you, at their fair market value on the date that they cease being a Canadian tax resident. And so in this light, half of any net capital gains resulting from this deemed disposition are going to be included in your income and taxed at normal marginal tax rates here in Canada. And the logic here is that this ensures that Canada collects the tax related to the portion of the gain that accrued while the individual was a Canadian tax resident. So there's quite a bit to unpack here, but before we do, it needs to be mentioned that this departure tax does not apply to certain types of Canadian assets, such as Canadian real estate, Canadian business property and inventory, as well as assets held within RRSPs, RRIFs, company pension plans, RESPs, and TFSAs. Do keep in mind though that as a non-resident, you don't gain TFSA contribution room for the years where you're a non-resident, as well as RRSP contribution room, because you're generally not earning Canadian income, which is what dictates your RRSP contribution room. And even if you do keep these accounts open though, being a non-resident, well, there are ongoing tax complications, such as a 25% withholding tax on RRSP withdrawals, and your RRSP withdrawals may even be considered taxable income in the country where you become a resident. That is the case for the United States. Now, on the other hand, for your TFSA, it remains a valid account in Canada, and any income earned or withdrawals made from the TFSA will continue to be tax-free in Canada. However, again, if you move to the US, the USA does not recognize the TFSA as a tax-free account. So for US tax purposes, your TFSA is treated as a foreign investment account. And so for this reason, along with other tax complications, it often just makes sense to cash out the account before leaving, because your withdrawals are tax-free anyways while being a resident of Canada. Now, what is subject to this deemed disposition and departure tax though are investments such as stocks, bonds, ETFs, mutual funds, and other paper investments held in a non-registered investment account, along with personal belongings of higher value, generally above $10,000 in value, and real estate that is outside of Canada, weirdly, like a vacation property. Now, I'm assuming the reason why the departure tax doesn't apply to Canadian real estate is because from a practical standpoint, it would basically be impossible to pay this departure tax without actually selling the property off. That would just not make any sense at all. But for any investment accounts that you hold, you will be required to pay capital gains on the assets even if you aren't selling the investments. So of course, you need to consider what this means for your situation and consider your intentions long term. But if you truly plan to permanently leave Canada, you're probably better off actually materializing those capital gains and taking them with you, since you're already subject to their taxation on departure. And this will make tax reporting much easier as well for you years down the line. All right, bottom line, just keep in mind that if you do leave Canada and become a non-resident, you need to file Form T1243 on your tax return for the year in which you departed, which will allow you to report the assets that you're requiring to dispose of figuratively and pay the required capital gains tax on them. Overall, this departure tax really sucks and is one of the main reasons why many successful people in Canada who have large investment portfolios and successful businesses find it difficult, if not nearly impossible, to leave, because they don't want to be subject to a massive tax bill on their investments without actually even selling them and truly materializing the capital gains. Now, if you own rental real estate as a non-resident, things get even more complicated, can you believe? Let's cover that now. Okay, so if you're an individual who owns real estate at the personal level and plan on becoming a non-resident, you have some serious planning and strategizing to do beforehand. And you might just want to even consider selling the properties while you're a resident, as if you rent out a property in Canada, your tenant or an appointed agent will be required to withhold tax in the amount of 25% on the gross rental income earned and remit this to the CRA on a monthly basis. When I found this out, I nearly fell off my chair, as that is one of the most ridiculous things I've ever heard that's clearly in place just to discourage non-residents from owning real estate. As depending on the scale of your portfolio, this would be a logistical nightmare. So even though this is just a prepayment of taxes and the true amount of tax is determined at the end of the year, where you may very well get a refund, well, from an ongoing cash flow standpoint in the business though, prepaying 25% throughout the year can be highly unfeasible in many cases. Additionally, if you're considering selling your Canadian real estate while you're a non-resident, the CRA will require that 25% be withheld from the gross sale price upon sale, except for your primary residence. So again, a very large amount of tax that's being prepaid here if you're a non-resident, which many people won't be interested in pursuing. Now, if you're wondering if this applies to your house, your primary residence, well, you have 1 year to sell the house after becoming a non-resident without having to worry about any tax implications. But after that, you would pay a prorated gain that would be taxed relative to the years being a non-resident. For example, $300,000 in capital gains over 6 years of ownership, with 2 of those years where you're a non-resident. Well, you would be taxed on $100,000 worth of capital gains. I hope that makes sense. Now, overall, maintaining a house in Canada if you're a non-resident anyways will be more complicated and come with additional costs and headaches, but this is still something that needs to be considered, as many people may want to start off with splitting time in Canada and another country. So definitely keep that in mind if that's a situation that you find yourself in. And finally, there are some other things beside taxes that need to be considered when becoming a non-resident, specifically relating to healthcare. Now, generally speaking, as a non-resident, you lose your healthcare privileges in the province or territory that you previously resided in. However, the details and rules are going to differ from one to the other, so I'd recommend you do ample research on your own province's website. This is typically information that's all made public and relatively easy to find. Canadian healthcare coverage, though, usually expires 6 to 8 months after moving overseas, though there are some exceptions for students and other special groups, and this is because your coverage is contingent on your residency status in your province, right? Back to the residency status that we spoke about at the beginning of the video. Now, for sake of example though, here in my province of Quebec, to remain eligible for health insurance, you must not be absent from the province for 183 days or more per calendar year. All right, so that's definitely something to consider, as depending on where you're going, you'll probably have to budget in healthcare insurance, right? A plan plan, which can easily be hundreds of dollars per month. Please let me know if you have any other questions relating to exit taxes and considerations when looking to leave Canada down below in the comments. Honestly, there's a lot I left out here because this video could be an hour long. Things relating to Canadian controlled corporations, right? If you have a business, a corporation, what happens when you leave Canada? I know a lot about that as well. So any questions you might have, make sure to let me know down in the comments. I will answer as many as I can with the knowledge I possess. And don't forget to also check out the links down below for free money and resources I use to invest, along with these two videos right here. So thanks a lot for watching. Subscribe.